Hi there, everyone. This is Mike Kramer of Mott Capital. Today is Tuesday, March 12th, and it's around 4:45 New York time. U.S. markets are closed. Today we got the US CPI reading. That did come in hotter than expected on year over year at 3.2% versus estimates for 3.1. Core inflation rose by 3.8% versus estimates for 3.7. CPI month over month rose by 0.4%, in line with estimates, and CPI ex food and energy rose 0.4% versus estimates for 0.3. On Wednesday morning here in the U.S., we'll be getting retail sales. Then on Thursday morning, we're going to be getting PPI, along with initial jobless claims. And then on Friday, we'll be getting University of Michigan preliminary March inflation expectations. So the PPI numbers will obviously be very important, because when we take the PPI numbers and combine them with the CPI numbers, analysts will be able to dissect and get a better view on what the PCE is looking like for the month of February. Also, obviously, retail sales are going to be a big number as well, which come tomorrow. Additionally, I'm going to draw everyone's attention to Japan. Next week, we're going to have the Bank of Japan policy rate decision. That will come on March 19th. This is going to be a very important rate decision. There have been rumors that the BOJ has been considering raising rates. There will be some important wage data, I believe, coming on Friday, which will also potentially have an impact on whether the BOJ decides to lift rates for the first time in many years. The Japanese yen has been responding to these expectations, although it was weaker today. You can see that the Japanese yen has returned all the way back to this 146.20 area. I had noted last week that it looked like the yen was setting up a bull flag and that we could potentially move higher. Likewise, the risk was that if we broke through resistance, we could return to this lower level. And thus far, that is what's happened, because expectations have been shifting from a BOJ doing nothing to the potential for a BOJ lifting rates out of negative territory. Again, we need to continue to watch the yen, just because the yen is a very important currency pair. And obviously, if we were to break this 146.20 area, it probably sets up a steeper drop back to this 141.60 area, and may even mark a lower high here, which could potentially be important, signaling that the highs in the yen are now in, and we're looking for a yen that may be heading lower. So this is going to be an important period of time for the yen versus the dollar pair. When we look at the US dollar versus the euro, we continue to more or less consolidate sideways here. The dollar was basically flat today versus the euro. Even though you got that hotter than expected CPI print today in the US, I still think that the upside risk is somewhere to around 1.10, while I think the downside risk is somewhere around this 1.07. We can see that momentum overall has been bearish now for some time, and we've just really been consolidating sideways. And this consolidation could still go on for some time longer. It just seems as if there's still plenty of room for this to continue to oscillate back and forth. I think as the market needs to digest and figure out which central bank is really going to be the first to cut rates, certainly the CPI data today in the U.S. would lend to the idea that the ECB may be going first, and that the Fed may be going second. But certainly the price action we got out of the euro today certainly doesn't really give you much confidence that the euro will be heading lower. But again, I think right now your level of support in the euro comes around this 108 area, leading to that breakdown to 107.5, while a push above this 109.5 area potentially projects up to this 1.10 area. The pound, so when we go over to the pound had been consolidating for a couple of weeks. It looked like it was going to break lower, then all of a sudden it turns up the other way. And now you can see that the pound has sort of broken out above this resistance at 128. It came down, tested it today, and managed to close above the 128 area as well. So as long as this 128 region holds, I think it sets up a potential move back to this 129 area, and certainly momentum appears to be favoring the pound going forward higher, while a break obviously sets up a decline back to this 126. When we look at rates here in the U.S., we can see that the 10-year has dipped back to this 4.10 area. The 10-year auction didn't really go particularly well today. Tomorrow we're going to be getting a 30-year auction at 1 p.m. Eastern. So as long as the 10-year holds this 410 area, I think that you're going to probably see a revisit back to this 433 area, while a break of this 410 area potentially breaks the uptrend that's in place and sets up a decline back to this 390. The 30-year also, again, as mentioned, we have that 30-year auction tomorrow at 1 o'clock, and a weaker auction could potentially lift the 30-year back to this 440 area, while a break of support at 420 sets up a retest of this 398 region. So again, I mean, you have this basic uptrend forming in the 30-year. You have momentum trending higher. You have economic data that seems to be supportive of higher rates. And so one would think, just logically speaking, that you would see rates on the longer end of the curve continue to move higher. We are obviously in the midst of a blackout period here in the U.S. with the Fed meeting not coming till next week. You did see 2-year rates rise, and the 2-year probably has a decent amount of resistance at this 475 area, while a break of 448 probably leads to a decline back to 425. But again, the data we've been seeing out of the U.S. kind of makes it hard to make a case for the 2-year rate or rates in general going lower. Clearly, retail sales tomorrow will have an impact, and then, of course, PPI later this week will also have a say in terms of where this economic picture looks over the short term. When we swing over to the NASDAQ still is in this megaphone pattern that's been forming overall. I mean, when we look at the NASDAQ, it really hasn't gone anywhere since, I would say, February 12th. You can see from this high to where we are today, we're only up about 1%. So it makes it certainly sort of like, it feels like the NASDAQ is moving a lot, but it's really not going anywhere except marking time with big volatility swings. And so that's not by definition sort of what a rising megaphone pattern is. It's usually notated by widening amounts of volatility in broader ranges. And that's pretty much what we have here. So today we had the NASDAQ rise by about 1.5%, even though the CPI report was high. Basically, that's because we had implied volatility really jump yesterday going into that CPI report. And then, of course, once that CPI report hit, implied volatility dropped like a rock. And that led to and that basically gave equities that boost right out of the open that really sort of just propelled them the rest of the day. And once we got that jump higher, volatility never really went back up to push stocks back down, and rates really simply just didn't move enough. And so this largely had a lot to do with what we were seeing in the equity complex today. Volatility for the most part has reset at this point, so I would expect that we're going to see the equity market sort of settle down a little bit here. I mean, for the equity market, the NASDAQ particularly, it's a fairly straightforward process at this point. First of all, you can use your upper Bollinger Bands as levels of resistance, which would come at 18,390 and support it at 17,450. I mean, clearly the NASDAQ really hasn't broken the 20-day moving average meaningfully for a pretty long time, and for the most part has been finding support there. So support probably still exists somewhere around this 20-day moving average, while you have resistance at this 18,380 area. The next area of resistance would be at the top of this candle from Friday afternoon, which would come somewhere around 18,400 or so. And then, of course, at the top upper end of this range of this broadening rising wedge pattern, which would be somewhere around 18,600. Obviously, this wedge continues to rise, although at some point we should see it either break meaningfully higher or see it revert and break lower. Typically, rising broadening wedges do tend to be bearish patterns over time, so we'll just have to keep an eye on this to see how it sets up. But right now, I think it's a pretty well-defined setup for it. When we look at the Dow has also been sort of just meandering really since February 12th. Again, not a really big move in the Dow, less than 20 basis points. Again, the index rallied by about 60 basis points today because it didn't have the effects of NVIDIA and some of those other AI related names. All we really did at the end of the day was fill the gap from this drop opening on March 4th. Again, you don't really have necessarily the same characteristics of that broadening rising wedge that you have in the NASDAQ. But again, what we do have at least is levels of resistance and support we can use and look at. And basically, when we look at the Dow again, the 20-day moving average for the most part has been serving as a support region, with the exceptions of a couple of days, while the upper Bollinger Band tells us that probably resistance is somewhere around 39,275, with support right now at 38,300. And so again, I think it's really going to depend on where rates go from here. If we start seeing rates really rise rapidly, or if we continue to get hot economic data that's going to cause the dollar to surge and rates to surge, that should in theory lead to tighter financial conditions, and generally speaking, stocks do not perform as well in tighter financial conditions. So we need to be mindful of this and really be mindful of where rates are going, specifically how that 30-year auction even goes tomorrow. And of course, if the economic data continues to support rates moving higher, then it's going to make it tougher and tougher, I think, for stocks to go up, because the data is going to continue to suggest that the Fed wait longer to start cutting rates, and that's going to strengthen the dollar as well. And then finally, when we look at the S&P, it actually performed really well today, and out of all the indexes, it's really kind of done the best, at least since February 12th. February 12th was all the way back here, and you can see the S&P has actually risen by 2.5%, which is surprising given that it's done better than the NASDAQ, which what you really wouldn't think, given how the indices are sort of set up. And again, when we look at this overall, the S&P 500 at least has this upper band of resistance somewhere around 5,200. We also have this rising trend line here that also finds some resistance around 5,200. You also have the top of this wick from Friday as well that exists around 5,200 as well. The call wall in the S&P 500 is around 5,200, which is a big level for options expiration on Friday. So 5,200 right now may continue to be the upper end of the trading range, and that may limit upside that we're going to see in the S&P for the next couple of days. Again, it looks like we're just sort of moving and consolidating into a tighter range. It doesn't have that broadening wedge pattern that the NASDAQ has, so not quite as much volatility perhaps. But overall, it looks to me like as long as we stay below 5,200, you want to look for maybe a retest of this trend line at 5,130. But obviously, if you get above 5,200, things to the upside start to really open up. And next week specifically, because call gamma, it will decrease dramatically. And so that will probably mean that the equity markets will be free to move in a little bit of a wider range. Anyway, that's all I have for you. Until next week, have a good one. Bye.